Hey guys, hi. Welcome to another episode with me, Shashank Udupa. And in this episode, we're going to tackle one new industry. We're going to look at a new industry, and this is by far my favorite industry as well. And this industry is known as specialty chemicals. And I have seen a lot of people in the comments also asking for specialty chemical industry overview. So we're going to do something like that in this episode. So guys, what are specialty chemicals? Now this is something that everyone wants to know, what specialty chemicals are, and why is this industry trending upwards from a very long period of time? Why is there so much buzz about the chemical industry? So let's understand how the specialty chemical industry works. Let's understand how the chemical industry works first, and let's see why it is so important in India. Now, the specialty chemical industry is very pivotal as it's like a building blocks that is required for all industries, especially in the agricultural and in the industrial segment. So if you want to do anything in the agricultural or industrial segment, you need certain type of chemicals that are very important to function for that industry. Now, if you look at some of the industries like this, there are paper, there's textile, there's detergents, soaps, etc. A lot of different things that way. Now, this covers around 80,000 products that are there. More than 80,000 products this entire industry covers. And this industry is used and it services a large number of clients in the end use application of these clients. Okay, so it is always there, pivotal in every stage of building a final product. If it's a soap, there's a lot of chemicals used in building that soap. Now, in India, the chemical industry, the massive industry employs around 2 million people only in India. So that means the industry is also quite massive. Now, these chemical industries can also be further divided or further classified into various categories depending on their end use case journey. Now, if you look at their end use case, as I mentioned, there is paper, textiles, agriculture, but then there are some other industries like polymer additives. There's also different type of dyes and pigments. So this is a very, very, very vast industry when it comes to the chemical sector. Now, within the chemical industry, let's understand one more thing. Within the chemical industry, there is two broad divisions. Now here comes our specialty chemical. So there's two broad divisions. Now these two broad divisions are basically commodity chemical and specialized chemical. Now commodity chemicals are basically like bulk, high volume bulk products. They have less margins and there's less differentiation between the two. Right? But again, see, if you think about bulk commodity, if you think about commodity specialty and also the specialized chemicals and the commodity chemicals, the line between the two is very blurry. Right? There's very few chemicals that are slightly better on the special side and slightly not on the non-special side, which is the normal commodity side. Now, if you look at this, the commodity chemicals, okay, these are the basic chemicals that are usually high volume, bulk kind of products where it works on a high volume. So that means the margin is slightly lower and there's very less scope for differentiation. But where the money is the specialty chemicals. Specialty chemicals are slightly lower in volume because it takes so much extra effort to do this. High margin products and they are sold to very niche segments. So that means the demand for these things are high. Demand for these segments are high. That is why specialty chemicals is extremely, extremely important. And that is where we're going to look at in this episode as well. We're not going to look at the commodity side. We're going to look at the specialized sector. Now, why is specialty chemicals so important? Now, in terms of both, specialty chemicals slightly has an edge over the commodity chemicals because why? It has customer loyalty and it has slight product differentiation. Now, if you think about it from that perspective, you have to make a special chemical, a new chemical specialized for a specific industry. Okay, now if you make that, very few people can make that. So obviously your competition slightly reduces. Now there are so many clients who want this specialized chemical maybe for some ingredient of their own product. So you have very few people making this. That means the demand for this would be more, the supply would be slightly less. And it's also a difficult process to make the specialized chemicals. So that is why the specialty chemicals have a slight edge over the commodity chemicals. Now, they are also able to generate a more stable stream of revenue compared to commodity businesses. Why? Commodity businesses are very cyclical. As we saw in our commodity video as well, commodity chemicals and commodity businesses are very cyclical because it depends whether the commodity at that point is in demand, trending or not. But if you look at specialty chemicals, they're mostly stable because they're required throughout. Now, finally, the biggest differentiator is because most specialty chemical formulations have a patent on them. They're patent protected. So it's not very easy to copy it. I can't just be like, okay, you know what, that guy made a specialty chemical, I'm just going to copy it straight away. Obviously, there's a patent, so I can't copy it exactly. I have to work around the patent. It is also a very difficult process to do that. And if I have a patented specialized chemical formulation, then obviously my price is better. Now, all of these combined, okay, I think it's very clear for you guys as well that all of this combined makes specialty chemical sector a very attractive sector over and above plain old commodity chemicals. Now guys, let's look at how the industry looks like. The specialty chemical industry, let's look at how it looks like. Now the market for this specialty chemical obviously is there domestically and internationally. So there's market overall because this is something that is a niche market. You don't have so many players creating such kind of special chemicals. So the market is there domestically and internationally. However, as I mentioned in the previous segment, that China has an important role played in the specialty segment. Let me tell you what it is. Now, China earlier on had been able to capture the entire market internationally by giving these specialty chemicals at a very cheap rate. And China was like dominant at that point. They were like number one. They had captured the entire market and they were selling their specialty chemicals at very cheap prices, which we couldn't match at all. Now, something has changed recently. In China recently, they have come up with this new initiative where they want to cut down pollution and reduce the carbon emissions. Now, China has recently taken that step. Now, what happened here is many coal burning plants were forced to shut down. Others were asked to temporarily shut services and wait until they start being compliant with the environmental pollution emission new laws that they have created. And one of the industries that did get affected by this was chemical industry. Why? Because the chemical industry was a big cause for pollution in China as well. They were one of the worst polluters in the country, and both the chemical companies over there took big hits on their profit. Why? Because they couldn't produce more because they had to stop. They had to stop because of this new rule that had come out where they want to reduce the pollution. Now they have to upgrade their plants to be less pollutant towards the entire globe. Right? Now, what happened here? Because all these things were happening in China where they wanted to, reduce the carbon emission that was coming out, all plants stopped. What happened was India stepped up. And this was the point. India was like, you know what? I have so many plants in India, and India, by the way, most of them already have eco-friendly tech. So the reason why Indian prices were slightly higher as compared to Chinese prices was because Indian companies had already invested earlier on in eco-friendly tech. So their carbon emissions were not that bad. They weren't polluting the entire region. Right? So that is why Indian prices were slightly high. And China competitors had an edge because they didn't have these compliant issues. So they didn't spend a lot of money, so they could sell something at a cheaper rate. But now what happened? As soon as China had this small, cutback, India stepped in and said, you know what, I will cater to this demand that is there globally, both domestically and internationally. India stepped up, and all the Indian players, the chemical sector players, came up and started taking on deals which were not there for India before. Now, you will be like, okay, you know what, Shashank, but this was a temporary issue. China will eventually, all these plants will become eco-friendly and they'll come back and they'll start selling. Now, that is true. Okay, now, and the entire industry knows that the China exports will again start coming back into the market. They'll again start selling these products. But this time, they can't sell it at very cheap prices like they did before. Why? Because even they have now installed this new, carbon emission reduction technology. They have tried to become more eco-friendly, and that adds to the cost. That adds to the cost of your specialty chemicals. Now, Indian manufacturers are also focusing on the increased demand that is coming from the domestic segment. Yes, so apart from the international segment where they're capturing the Chinese dominance and they're capturing all the clients of the Chinese chemical plants, in India also we're growing a lot. And now remember where these specialty chemicals were used in. They were used in, if India starts buying more clothes, okay, you need it in dyes and pigments. If India, is doing a lot of packaging requirements, right? If you're sending a lot of stuff or you're buying a lot of parcels, there's a lot of specialty chemicals that goes into the plastic sector, in the packaging sector. So as the consumption of India grows, right? If India becomes a growing nation and the consumption of India starts growing, the need for specialty chemicals slowly starts increasing as well. And if that happens, the domestic need and the demand for these specialty chemicals have also increased. And because of that, the specialty chemicals are also doing well again from that side. So that is why it is important to understand how the global scenario is being played. Internationally, we saw why the Indian players won because of China's downfall on the pollution. And we're also seeing how India is winning inside India because all these players are now satisfying the new demand that has come up from the domestic players. But now the problem is in India, there are a lot of unorganized players in the segment that's catered to smaller unorganized customers also. Okay, now obviously small customers cannot go to big clients and say, you know what, give it to me because it'll be very expensive. So there are a lot of these small unorganized players catering to the unorganized customers in these small subsegments. For example, if you look at in flavors, right, in flavors and fragrances, the entire market is mostly unorganized and they cater to tobacco and incense sticks. Whereas if you look at in surfactants, these players cater to a lot of unbranded soaps and detergents in the market. So there is a lot of unorganized player and unorganized market is there in this market as well. So the unorganized side is also there, the organized sector is also there. So we need to see how that would also play around in India. Now, globally, the specialty chemicals in India grew at 5.7% compounded annual growth rate, CAGR, over the last 5 years. In 2019, it is estimated to grow by around 6.4%, more than what it had grown in the last year. It's expected to grow by 6.4% over the next 5 years to reach an entire industry over value of $1.2 trillion by 2025. This shows that the market size of the specialty chemicals industry is massive. Now, what I'm going to do is I'm going to show you some specialty chemicals and their market size here. Okay, just to give you an understanding of how this 1.2 trillion or can happen in 2025. So if you look at it, the biggest, as I've put it in the order, if you see this chart, the biggest one is in colorants, a dye and pigment used to color something. Then we have paints and coating, polymers used for painting. In agrochemicals, chemicals used in agriculture, mainly pesticides and fertilizers. Flavors and fragrance, chemicals which add flavor and fragrant. Surfactants, detergents, wetting agents, forming agents, etc. These are the top 5. If you look at this, just take the most amount of the top 5 chunk of the entire market. Okay. Now in the next segment, we're going to look at 5 companies in the specialty chemical segment by their market cap, and we're going to discuss what they do and how they do. So some of the companies you would have heard of as well. Okay. So I'm going to see you in the next segment. Okay, now in this segment, let's look at the top 5 specialty chemical stocks dependent on their market cap. And the top 5 stocks that we're going to look at are Pidilite Industries, UPL Limited, Pi Industries, Aarti Industries, and Deepak Nitrite. So let's look at them one by one. Now the first company that we will look at is Pidilite Industries. Now we've heard of Pidilite, it's a household name, but if you don't understand which company this is, let me get into it more. Now, Pidilite Industries mainly operates in the Indian adhesive manufacturing company. Okay, it also sells a lot of materials, construction chemicals, and other industrial chemicals as well. If you look at the company overview, it was formed in 1959. It is the #1 adhesive company in India. It has around more than 5,300 permanent employees, operates in about 9 countries. It is in India's Super 50 company list. They have 3 R&D centers. They have 18 international and 9 domestic subsidiaries. They export to more than 80 countries. My God. They have more than 500 different products, and they have 23 manufacturing plants and 23 co-makers as well. Now, what does this do? You'll be like, Shashank, this is like massive. What do they actually do? This company is, and you guys know about this, is a company that manufactures Fevicol, right? So if you know Fevicol, Fevikwik, Dr. Fixit, you might have seen all these ads of Dr. Fixit. So they are in that segment. Okay, the Fevicol works in the woodworking, wall and wood finishes. In construction, they have Dr. Fixit and Roff, the tile fixing solution. Then they have Fevikwik as well. Apart from that, this is from the consumer side that we see. But from the business angle, they're also into textile, paper, industrial resins, organic pigments. They're into industrial bonding. They're into maintenance, repair and overhaul. They're into industrial adhesives, leather chemicals and footwear adhesives. So they're into a wide array of different businesses, and I'll show you their revenue split as well. If you look at their revenue split to see where the money is coming from, 55% of their money is coming from the consumer side of the business, which is Fevicol, Fevikwik and M-Seal. That is 55%. Remaining, if you look at 20% of the business is coming from Dr. Fixit and Roff. Now, if you look at 9% of the other business is coming from Fevistick and Fevicryl, and the remaining other 15% comes from the rest of the business, B2B side of business. But majority of their money comes from the B2C side of the business. Now, let's look at some financials of Pidilite as of today. They're at a market cap of 95,000 crores. Their current PE ratio slightly higher at 84.85. If you look at their ROE, it is at 25.39%. Their operating profit margin, which is very good, at 23.05%. Their debt to equity ratio, very negligible at 0.06. And their 1 year return is at 35.7%. So that is what Pidilite Industry works with. Now the next company that we're going to look at is UPL Limited. Now UPL Limited is in the agri-chemical space. It is a global generic crop protection chemicals and seeds company. Now what they do is they're also engaged in the business of agrochemical industrial chemicals and the chemical intermediates that are required in the agricultural sector. They operate in 3 segments, which is agrochemicals, industrial chemicals and others. Now, their primary business is the agrochemical business. The company is the 5th largest company in the crop protection company globally and has presence in more than 138 countries. Now, let's look at some of their region-wise revenue breakup. So, let's look at that. If you look at the region-wise revenue breakup, India, right, is the highest with 22%. So, their domestic play is highest. India is number 1. That means the domestic consumption of these agrochemicals that they provide in India is massive. Second would be Europe, which is at 12%. And third is Latin America, which is at 8%. Now, the impressive aspect of UPL, or why it is so good, is that while they have growth in the post-patent solution is there, they have good growth in the differentiated solutions as well. Now, why this is so good is because, see, once you have a new product and then you patent it, and then after post-patent is over, you still have a good growth. But then they also have, because they have 20 R&D facilities, they've also made a lot of different solutions to build their play. Now, let's look at how the portfolio segmentation of these crops, of these different products are as well. Look at this image. Now, if you look at it, the post-patent solutions in FY16 was 86 and the differentiated and sustainable solutions were 14. But if you look at it in FY21, see how it has grown from 14 to 29 and the post-patent has reduced from 86 to 71. That means the post-patent solutions have gone down. And if you look at the CAGR growth, only 13% CAGR growth on the post-patent solutions, but 35% CAGR growth on the sustainable different solutions. So it is a very good thing that they've grown their differentiated and sustainable solution brand as well. Now, if you look at their new products pipeline with peak sales breakdown, 20 new products coming in the post-patent and 80 new products are coming in the differentiated and sustainable segment. And these products also have, these are the new pipelines that are coming out with them. Now, if you look at their financials of UPL, look at this. The market cap as of today is at 52,000 crores. The P ratio is at 17.45. The ROE is at 16.29%. Operating profit margin 21.58%. Debt to equity ratio slightly little higher on the side compared to Pidilite, which is at 1.16. The 1 year return is 77.51%. Now, the next company that we're going to look at is Pi Industries. Now, Pi Industries is an agri-sciences company with a strong presence in both the domestic and the international markets. The company has 4 manufacturing facilities and research facilities in Udaipur. The company has 12 multi-purpose plants, 5 formulation plants, and the company also has an international presence in Germany, China, and Japan. Now, Pi Industries basically operates in the domestic agricultural inputs and the CSM export segment, and is a leading player in the domestic agricultural input segment. And it primarily deals with agrochemicals and plant nutrients. Now, if you look at the revenue breakup, most of the revenue comes from exports and very small amount of revenue comes from imports. So export revenue is 683 crores and the import revenue is, and the domestic revenue is only 172 crores as of in India. Right? Now, if you look at this, the company has also partnered with around 20 global corporations and has exclusive rights with some of the people in India for distribution as well. On the back of such exclusive engagements with renowned agrochemical companies and fine chemical companies and pharmaceutical companies across the globe, Pi Industry has built a very strong portfolio. That is why it is good. Why? Because they have some exclusive deals with a lot of companies. Now, R&D expenses form a sizable portion of the total expenses of the company, and it is very big, right? Now, why is that good? Because the company is spending a lot of money on research and development to become better and to get new products into the market. New products equal to more chances of making more money. Now, 10% of the company's workforce works in R&D facility. Literally, that's very high. 10% of the entire company's workforce works in R&D facility at Udaipur. The company focuses a lot on finding new products. They focus a lot on custom synthesis, manufacturing of new products in CSM segment, and that accounts to 2/3 of the revenues of the company. Now, custom synthesis basically means the exclusive synthesis of compound on behalf of a customer. It's like a custom order that they have to do. You can order a specific molecule that you want to be synthesized as per your request. So this is something that they do for a particular customer. Now, if you look at the financial ratios of Pi Industries, currently, they're at a market cap of 40,600 crores, P ratio at 60.73. Their ROE is at 18.55%. Their operating profit margin is at 22.92%. Debt to equity ratio almost negligible at 0.08. And their 1-year return is 76.89%. Now, the next company that we're going to look at is Aarti Industries. Now, Aarti Industries is a leading industry manufacturer of specialty chemicals and pharmaceuticals and is also there in the global space as well. It's not only for India, but it's also there globally. It operates in two segments, as I mentioned right now, is specialty chemicals and in the pharmaceutical sector as well. Now, this company was established in 1984 and the company is one of the leading benzene-based specialty chemical producer in the world. Okay, it is one of the leading benzene-based specialty chemical producer in the world. The company has 4 R&D facilities and has a pool of around 300 plus engineers working on this. The company has 13 specialty chemical plants and 5 pharmaceutical plants, and they're mostly located in Western India with very close proximity to the ports. So the logistics cost is slightly less, very smart. Now, overall, the company manufactures more than 200 products and caters to more than 400 global customers and has more than 700 domestic customers. Now, let's look at the revenue split by region. 60% of the revenues come from the domestic market, 14% comes from the European market, 9% comes from the North American market, and the remaining comes from rest of the world. Now, if you look at the revenue segment by business, okay, by revenue segmented by how the business works, 83% of their revenue comes from the specialty chemical business and only 17% comes from the pharmaceutical business. That means specialty chemical segment is massive. Now, let's look at some of the financial ratios of Aarti Industries. The current market cap is currently at around 30,000 crores. The PE ratio as 60.93. Their ROE is at 18.88%. Their operating profit margin is at 21.5%. Debt to equity ratio slightly lower at 0.68. And their 1-year return has been 68.99%. Now, lastly, let's talk about the fifth company, that is Deepak Nitrite. Now, Deepak Nitrite makes both commodity chemicals and specialty chemicals. The company basically operates in 3 main segments. Number 1 is fine and specialty chemicals. Number 2 is performance products. And number 3 is basic chemicals. Now, in 2014, this is very important. Listen to this. In 2014, the company decided to set up a manufacturing unit for this thing called phenol. Okay, or phenol. A company used in automotive linings, laminates, coatings and paints. They used a separate subsidiary for this called Deepak Phenolics, and phenol was used as a byproduct. Okay, so phenol has a useful byproduct also known as acetone. Now, this is important because the domestic production only accounts to 20% of India's demand and the rest has to be imported. So now that was a very genius move because both the phenol was also important in India and the byproduct was acetone, which was also needed in India. Now, the company has 1 phenol plant and 1 acetone plant facility at Dahej. Now, if you look at the manufacturing capacity, if you look at this image, their manufacturing capacity for phenol is around 200 kilotons per annum. Their manufacturing capacity for acetone is 120 kilotons per annum. If you look at their capacity for cumene, it is 260 kilotons per annum, and isopropyl alcohol, or IPA as usually called in the industry, is at 30 kilotons per annum. Now, if you look at the different manufacturing plants or manufacturing facilities, that they have one in Nandesari, they have one in Roha, they have one in Taloja, they have one in Hyderabad, and they have one in Dahej as well, all catering to different type of specialty chemicals that they're operating in. Now, the company has a R&D facility in Gujarat with a team of around 70 scientists. The company is also the largest producer of sodium nitrate. The company serves its clients in almost around 30 countries and they have more than 100 products. And look at some of the leading clients that they actually cater to. And these are some big names in this image that you'll see. They cater to Bayer, Unilever, Indian Oil, Rallis India, which is a Tata enterprise, BASF, L'Oreal, Lubrizol, Reliance, and Nirma, the washing powder Nirma one. Now, if you look at the revenue split of Deepak Nitrite with the segment wise, the fine and specialty chemicals come up to around 46%, the performance products come up to around 39%, and the basic chemicals come up to around 15%. Now, if you look at the financial ratios of Deepak Nitrite, the market cap is currently at around 24,000 crores. The PE ratio is at 31.49. The ROE is at 39.6, I think highest among all 5. The operating profit margin is at 28.6%. The debt to equity ratio slightly lower at 0.23, and the 1-year return an astonishing 244%. So this was Deepak Nitrite. So guys, I hope you guys understood the entire chemical sector in this episode. You understood how the chemical sector works. You understood how the industry of the chemical sector completely changed with the new laws that came up in China. And we know that tomorrow China will come back and start exporting their specialty chemicals. But this time we know for a fact that the Indian players are ready because they've already built that entire infrastructure right now to fight the Chinese exports that are going to come. You've also seen 5 different type of companies that are catering in the specialty chemical segment. Some of them in the specialty chemical, some of them for industrial, some of them are for agrochemical. So you have seen the difference for the top 5 companies in the by market cap in India with respect to the specialty chemicals. So again, the main objective of doing such videos is for knowledge, and I hope you've gained as much knowledge as possible in this industry. Again, you need to do a lot of research and reading by yourself. So please do that, but gain as much knowledge as possible. That is what is the most important thing in the stock market. Don't always think of how to make returns. First, understand how can I gain absolute knowledge about everything else in the stock market. Okay, so if you liked what I did, if you liked this entire episode, please like, share, subscribe, and don't forget to comment as well. This entire episode was built on a comment of someone saying that, you know what, we want something in the specialty chemical segment. So you give us more feedback, you give us comments in the comment section, and we will do more such episodes for you guys. So that's it. This is me, Shashank Godupa, signing off, and I'll see you soon. Hey guys, this is a disclaimer. Just understand that all the stocks that are shown in this video are not a recommendation from our end. This is only for educational purposes, so there's no recommendation from our end. It's only for learning. Okay?
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.